Hi everyone, welcome back to our investment video series titled Investment 201 with Dr. Peng. In the last episode, we talked about tariffs and deglobalization. And in today's episode, we'll be talking about a very exciting topic called investing in China. And who better than Dr. Peng to talk about with, right? So join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi Dr. Peng, great to have you back again.
Hello Isaac, this is great to be back.
Right, so today we'll be talking about investing in China, and to all our listeners who may not be aware, Dr. Peng Chen is a regular traveler to China, and he has been, every year he goes to China multiple times, right? How many times in a year?
Probably back and forth at least 8 or 10 times a year. So obviously I have a lot of obligations in Singapore. So I regarding Singapore as my residence country. But then, my parents are getting pretty old, and there's a lot of things happening in China that I'm interested in. So I often goes to China.
So you must be very in tune with the situation in China. So maybe you can go right into, what is the current situation in China?
Sure.
In terms of the economy and in terms of investing.
Sure. Let's start with the economy. So if we look at any country's economy overall, it can roughly by breaking into 4 parts. So there's the part of consumption. Basically, every time we go out, buy a meal, pay for a haircut, these are all contributing to the overall economic activity. That's consumption. The second part is government spending. So the government, by collecting taxes, they also spend money on, military, defense, education, healthcare for the entire population. That's also part of the economy. So those are the first 2 parts. Then you have import and export, particularly export, meaning that we produce things and we export globally. And then the last part, we call it's investment. Basically investment driven. So if I want to invest in a building, we're building a downtown, building a new building, and that create a lot of jobs, creating a lot of need for cement, steel. That's also economic activity. So by and large, any country can break this into those 4 parts. So let's take a look at China. Pre-COVID, and what's happening is that the consumption part is around 30%. Government spending is around 10%. And then the rest is investment and export. So very big on investment, very big on exports. Now, the investment part is basically most investment actually in China went into real estate, residential real estate, commercial real estate. So you see the city is booming. There has been a lot of demand because urbanization, people moving from rural areas to city, finding jobs, need apartment to live in.
And the culture of investing in real estate as well.
That's right.
When you get married, you have to get a house.
That's right. So you see, for 10, 20 years, it has been the drivers of the economy. What I mean, driver is the growth. It's really been investment into the real estate segment and the related. So once you have an apartment, you need to buy furniture, electronics, and so on and so forth, right? And then also exports. China becoming very, very efficient. It became the world factory, right? That's the term we use. Now, however, just like what we talked about in the last episode, during COVID, and there's a trend to deglobalization. So they put a lot of pressure on the export segment of China. So the external demand starts to shrink to small. And because many countries want to bring manufacture back to their own country and put a higher tax rate or straight out demand less from China.
Why is that so? Is it because they were not able to ramp up production within their own country? Of masks, for example, which caused them to kind of want to bring some of these back to their country instead of outsourcing to China?
Yeah, so there's multiple reasons. Like we talked about last episode, which we talked quite in details. there is this losing of critical manufacturing capabilities and not having it in-house. And so if it's viewed as critical, whether it's masks or whether it's ability to produce certain defense equipment, ships, if these are really security related, you probably want to manufacture close to where you are. So that's the first reason. The second reason is that it might be very good from a company or individual company perspective to manufacture in China, but certain employees lose out. And when more and more employees lose out, your society become a bigger impact. So there's multiple of these factors driven this deglobalization. And you can see a lot of countries rush out policies and so on and so forth on this. So export become a little bit weaker in China. So one of the driver is a little bit weaker. But more importantly, if you look at what happened in China, is that there's a significant overbuild in the real estate sector. A huge amount of overbuild. And so the government took proactive action, which I think is good action, to try to stop the ever-growing investment into real estate overbuild, because once it's overbuilt, nobody occupy those real estate and became bad that basically money wasted, right? And so the government tried to deflate the price of real estate sector and to bring it down. Now you can argue, whether it did it too quickly or whatever. What's happening is that the real estate segment across the board in China, the price dropped 30 to 40%.
Right.
Residential or commercial.
Right. The three red lines.
The three red lines. For many years, they tried multiple things. Finally, get the real estate segment, price and everything become a more normal. And of course, because there's overbuilt capacity, for the time being, the real estate sector, it's already overbuilt. There's less put it in from an investment perspective, continue to build. And so that activity has dropped significantly. By any kind of measure, probably half to 60%. So 50%, you can think of the second driver. The first driver, we talked about export being a little bit soft. Now it comes to the investment sector. It used to represent 20 to 25% of GDP. Half is gone. So you can think, 10% of GDP is gone, right? That's a pretty significant hit. And, so that basically describes what's happening in China. So it used to be investment to real estate plus export-driven economy. Now it's rebalancing itself to internal consumption-driven with a little bit more government stimulus, less depends on export and less depends on real estate investment. And plus some of these newer segments such as sustainable energy, which in China is called new energy, as well as more technology, high quality growth such as AI, robotics, all of these new things. But during this rebalance, you can see we're losing some segments fairly quickly. The new segment need to grow up.
Need to catch up.
But in this transition, it's causing a lot of pain. And so that's what's happening in China. And over time, if China can continue and successfully transition in from an export, real estate investment-driven economy to a much more sustainable, new energy, technology, high-tech driven, plus consumption-driven, it will be so much more stable.
Right. So in summary, in terms of export, it's a bit less because people are choosing to import less from China. In terms of real estate, the government, can I say, crashed?
Proactively took steps to rein it in.
To rein the real estate investments in, and because of how it's not just about real estate, right? I mean, there is impact on purchase of furnitures, delivery, etc. So the overall economy kind of took a hit on that, and China is trying to slowly but surely catch up and make up the gap in a way, the hole that was left behind from the I would say fall of the real estate.
So give you an example. So let's suppose the real estate represent 20% of the Chinese GDP, overall economy. And by rough estimate, 50% is now down 50%. So you can imagine 10% of GDP is gone. And overall Chinese economy has been growing around 5.5. So you can imagine 10% is gone. It will take at least 2 years, if not more, for the growth to catch up with where it was, 2 years ago, right? So it took 2 to 3 years to catch up. So this transition is not going to happen overnight. And plus, I mentioned with real estate, not only the activity is down, the price is also down 35 to 40%. And what's happening is that, Chinese, by estimate, there's around 70 trillion RMB investing into real estate. And so if it's down 30 to 40%,
it's massive.
A lot of your wealth is gone.
Yeah.
And so consumers are less likely, because they're less wealthy, they're less likely to go out and consume and so forth, right?
Yeah.
Just for example, if you and I live in Singapore, if the HDB market is down 30%, we're going to be saying, I lost some money. I'm not going to spend as much money going to expensive restaurants and so on and so forth anymore. Yeah. So that the consumption is also being impacted by the real estate. And the last point is very much what you said. For the other segment to catch up, it takes a bit of time. So for this high quality growth area, such as we all look at the electronic vehicles in China, they're definitely leading, right?
Yeah.
As well as solar panels, some of these new areas. But they still represent a very small percentage of GDP, less than 10%. So even though they grow very fast, they cannot replace what's been declining all at once. So it's going to take a few years.
Right. And you talked about new energy, sustainable energy growth in China. I think now they are the leader, if not the leader in terms of green energy.
It's absolutely the leader. Yeah, absolutely the leader.
Yeah. So is that something that you feel that would, in a way, be the next driver of growth for China?
It will be one of them, but like I said, it's still very small. Just by itself, it cannot, replace what's been a much bigger piece of the pie.
That's quite interesting. So, because of the extent of how real estate, the size of real estate was in the economy, even with the growth of China being now the leader in terms of green energy, when we look at electric cars, for example, BYD, we look at their exponential growth.
That's right.
It's still scratching the surface on how much they have to.
That's correct. To make it up. Yes.
Right. And so in that case, now that China is, kind of their real estate bubble, you can say it kind of popped.
That's right.
And they're trying to slowly catch up. But then, perhaps maybe at the worst time ever, the US started a trade war with China again, right? And it's not the first time. I think 2018 was the last time that happened. And now, of course, it seems like they're taking it to the next level with Trump's second presidency. So how does that change the overall picture of China?
Well, it definitely changed. Like I said, real estate and then export is have a lot of headwind we talked about, and we saw already Chinese economy in the first President Trump's term through Biden has been soft, right, for all of these reasons, and that has spilled, definitely caused the asset prices drop. We talk about real estate price drop. The Chinese stock market over the past 2.5 years also dropped quite a bit. Since last September, end of September, October, it rebounded a little bit. But overall, still last 3 years dropped quite a bit, by 20+%. And so you see during this transition, not only the economy is slowing down, but also the asset price of Chinese assets get readjusted, right? And also, I have to mention that because of the increased political attention, a lot of investors are forced to divest from China. Because, for example, a lot of U.S. institutional investors, such as a retirement fund that represent a lot of these employees, that they felt they were they didn't benefit from this globalization. Oftentimes you see them demanding people to divest from China. So you see the demand, the investment also get pulled out of China. So there's multiple these factors caused Chinese asset returns has not been particularly good the last few years, with the exception of Chinese bonds. Because with bonds, the government facing economic headwind, lower the interest rate, actually Chinese bond did fairly well.
Right, because when they lower the interest rates, the bond prices
Correct,
go up.
correct.
Right. So let's talk more about equities. I think you alluded to some of it in with your previous answer, but I want to know more about why people are, or rather the sensing that I get is that some people seem afraid to invest in Chinese equities, right? Some of the reasons quoted is that the government have significantly more control over companies as compared to companies that are listed in the US. So what are your thoughts on this?
Well, there are multiple factors. I think what you mentioned is certainly one of them. In China, the government and the regulators, part of the government, have a much stronger influence in the overall economy, and that has been historically like that for since China went on the journey to transition itself into market economy, have stock market and so on and so forth. So the policy has a huge impact. I mean, not to mention last September, end of September, where there was an important meeting led by the central government, and came out with a number of policy adjustments, and immediately the stock market went up 10 to 20% within a few days. So you can see the policy and the mentality of policymaker make a huge difference in China. So that's the first one, because in investing we're facing a lot of uncertainty. And so it's easier relative to study a company, what they're going to do with their future. Then you overlay with the sort of the policy or the other angle, it makes it more complex. So that's one reason I think people especially if they're not familiar with Chinese government or Chinese policy making process, they probably will be feeling this is very different and increase the difficulty. So that's the first thing. The second thing, there's a lot of other complexity, is that because the Chinese market is still relatively young, economy relatively young, the stock market, the bond market is relatively young. So you sometimes get a sense that where the regulation is a little bit behind, right? The regulated meaning that protection for investor, for property rights, and sometimes is a little bit behind where the market is. And so disclosures, company disclosures, punishment for fraud, all of these things that probably it's a little bit behind compared to where some of the more developed country, these things are very much well established. And so you see certain behaviors you would only see in the emerging market in the early stage happening in China. But in other part of the world, we're already used to, good rule law, trust-based system, contract-based system, that if you're mostly used to, after 100 years of development in the Western or developed world, you all of a sudden invest into China, there's a lot of these things are still in the early stage, you would have to adjust to. And then there's this capital control. issue. So if
where you can't easily take
exactly,
renminbi
and
out
so
of the
that
country.
sometimes they limit the opportunity. So for example, if you invest into China through the stock market such as Hong Kong stock exchange and going through Hong Kong Shanghai or Hong Kong Shenzhen program, they limit the number of stocks that you can get access to. It's not a whole market. So all of these things make it a little bit more challenging, and more frankly, depends on where you sit. It's also more interesting.
Right. So there's two camps essentially from what I hear from speaking with multiple people. There is one camp that really believes in the Chinese story, right? The China story. Whereas the other camp is more of like,
Absolutely no.
I don't want to touch China equities. I think most of the people that are in the second camp had Chinese equities prior to 2020, right? Your BABA, JD, at one point in time TAL, but we all know what happened to that, and all these companies in their portfolio, and they got burnt, and perhaps maybe that's why they feel that that's not something that they want to have. But how should we view it? Should we be in one camp? Or maybe I can ask you, which camp are you in? Are you somewhere in the middle?
I'm somewhere in the middle. So China is an emerging market, so we shouldn't view China anything different. So with the emerging market, like I said, we just talked about the policies, the regulation part, maybe a little bit behind. They need to catch up. So every time they catch up, there's going to be creating some up and downs in the market, and that's what's essentially happening in China a lot of times. And you cannot be too optimistic. So there are certain factors that cause optimistic views. Chinese is, as a very large economy, is growing very good, and they have made a number of advancements in a number of areas that it's clear evident the past 30, 40 years. So you cannot deny that. And you look a lot of new things. We talk about EV, we talk about new energy, robotics. They're world leading, right? So there's a lot of good things happen. The economy growing at 5%, not a bad number at all. When countries like US or other Western countries are struggling with 1% to 2%, right? So there's a lot of good things going. But we also talk about a lot of the difficulties or challenges and so forth. So you have to be, balance out both sides, and there's a lot of good things. You want to be investing in China. There's also a lot of challenges, and you need to be fully aware.
Right. I find myself somewhere in between as well. When you think about China, how can you ignore China, right? It's the world's factory. When you actually go to China, you say it's an emerging country, but some cities you don't feel that they are emerging. They're so high tech when it comes to their technology, in terms of their payment systems. You see the robotics everywhere, and now of course with the electric cars. So it's very hard to ignore China, but at the same time we don't want to brush off the concerns that some people might have. So my view is actually, to take what the market price China is. If we look economy-wise, they are quite close to the size of the US economy. Of course, not on a per capita basis, but in totality.
Yeah.
But when we look at the stock market, the US is, in a global portfolio, the US is weighted about 60%.
Yes.
China is weighted roughly about 5%, which is the weight that I hold China. I find it very hard to exclude China, but I'm also not overweighting above what the market cap weight is.
So that's probably a very sensible approach. So if you look at China, overall the economy is second largest, just behind the US in US dollar terms. If you use purchasing power terms, it's already exceeded the US number one. So the economy number two, stock market size number two, bond market size number two, mutual fund market size number two. So you have seen a lot of advancement in these stocks, bonds, and mutual fund markets, so investor can get access to. So you cannot really ignore it. In terms of specific weight, you mentioned U.S. represent about 60, China is representing around 5. That's more or less from a Western index perspective. So when the index provider produce those index, they
use the free float.
They use the free float, but also they adjust down the Chinese index representation because of these challenges. So it's actually underrepresented for the reason I mentioned, these additional cost frictions from a foreign perspective to invest into China. Now, over time, I think you're going to see China's weight, get bigger and bigger, given what we know today. So, but right now, it's probably a good number to look at in terms of, what's the percentage.
Being in China 8 to 10 times a year, right? And of course, flying to the US also quite often, right?
Yes.
And of course, coming back to Singapore. I'm sure who better than you to have a view about China, from a Western point of view, from a Chinese point of view, and of course as a Singaporean.
Yeah.
So, what are some common misconceptions that people have about China, right, or investing in China, you think?
So I think the first misconception is that just because there's some culture or there's some political system differences between China and the West, people assume that China is not investable, Chinese people are not happy, the Chinese government is bad and evil. It's actually, I find, with all these travel and talking to people in China, my friends, relatives, or strangers, the overwhelming majority of Chinese people are very happy. They're very happy with the continued, living standard increases. They are relatively optimistic in terms of going forward, opportunity, and so forth. You can imagine if you had a good experience, economic growth, better living condition, all of these things, better education, better health care over the past 30 years, you're going to feel pretty good about it, right? And but from the common, narratives that we hear from media, particularly Western media, they tend to focus on the problems that China has. So overall, Chinese people are happy. The economy is growing okay. It has its growing pains or the transition, but it's nowhere close to sort of. Sometime I read the articles on newspaper or watch TV, sort of the terrible situation. So that's clearly not the case. The economy is quite resilient, and people are working hard. They're producing a lot of value, to their customers or ultimately to the shareholders. So it's still investable. However, from a Western investor perspective, from an international investor perspective, I would discount because of all of the reasons we talked about at the beginning. And the other thing I want to say is that you want to also make sure when you're investing in China, have a little bit even longer perspective, just because it's an emerging country, and sometimes the cycles can get longer,
extended.
and also the up and downs can also be more severe.
Right. I think there's also, when we look at Western media, there's perhaps a political factor to it, right?
For
when it
sure.
comes to
For sure.
how they portray China, but it's good that you can give this unbiased view to our listeners and
Yeah. So basically, what I find is that when you're in China, you hear a lot more about the negative or not so good aspects about Western countries or US in particular. But when you are outside of China, when you listen to the media and social network and all these other things, you get a a bigger portion of the same thing, the not so good, the bad things happening in China too. So I think we just need to be balanced a little bit. Yeah.
I think this is a wider lesson beyond this debate, or rather this discussion, right? Is that when we read the news, we always not only have to see both sides, we have to see what is, is it because of clickbait? Could it be because of politics that they craft certain articles a certain way?
Yeah.
I think it really is a lesson for us to be more critical thinkers
Yes.
when it comes to reading the news and all the headlines.
Yeah. So lastly, I just want to leave with the viewers or listeners that, from an investing China perspective, China has been the largest, second largest economy, second largest stock market, bond market, mutual fund market, and so on and so forth. From an investment perspective, you just don't want to miss that market. For the same reason you don't want to miss the US market. It's too large to ignore it. And with all the things we talk about, the growing pains, the proper way again is to diversify across countries. Within China, diversify across different industries, different company, different asset classes. Like I mentioned, investing into China equities the last few years has not been a great experience, but the bond side actually did okay. So if you, again, using these investment principles we talked about, it will help you, smooth out the ride, and over time we'll get a better investment experience.
Right, there's definitely a diversification benefit, and who knows, maybe one day Chinese stocks would, drive the returns of global stock markets.
Yes, I think there will be, and then we talked about in tariff section and so forth. The U.S. and China is clearly going through a decoupling, process. I don't know where it's going to be ending, but just like we don't want to put eggs all in one basket, you certainly don't want to put all your eggs into U.S. or all your eggs into China. You want to diversify among those countries as well.
Okay, seems like a good place to end this episode. Thank you so much again, Dr. Peng, for your time and insights on investing in China.
Thank you, and love to hear from the viewers and listeners on these things, and love to hear from you. So write to us and comment.
Right, you heard Dr. Peng. So if you have any questions, please drop it down in the comment section below.
That's right.
And
that's right.
we'll be sure to look at them and reply to you in due time. With that, that's all for today's episode. I hope you enjoyed it. And if you like this episode, please remember to subscribe to our YouTube channel if you haven't done so already, and follow us on social media. As always, thank you all for watching, and I'll see you all in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.